Monetary policy is the process by which a country's central bank controls the amount of money flowing through the economy and the cost of borrowing that money, also known as the interest rate. Think of money in an economy like water in a pipe. The central bank controls the tap. Too much water flowing means prices rise out of control. And too little water means businesses can't grow and people lose jobs. Monetary policy is how the central bank finds the right flow. So there are two directions the government can take through the central bank. One is expansionary policy, by turning the tap on more, and here it will lower interest rates to encourage borrowing and spending. Secondly, contractionary policy. Here the government through the central bank tightens the tap by raising interest rates to slow things down and control inflation. So the central bank uses monetary policy as a lever to keep the economy stable. When the economy is sluggish, unemployment is rising and people aren't spending. So the central bank cuts interest rates. Borrowing becomes cheaper. Businesses take out loans to invest. Consumers spend more and the economy picks up. On the other side, when inflation is running high, which means the general price level of goods and services keeps climbing, the central bank raises interest rates. Borrowing becomes expensive, people and businesses spend less, demand cools down, and prices stabilize. So the goal is always to balance. You keep inflation low, employment stable, and the economy growing in a healthy pace. So what does this mean for businesses? When interest rates are low, businesses can borrow cheaply to expand operations, hire more staff, and invest in new equipment. Consumers also have more money to spend, which boosts sales. This is generally a good environment for growth. But when interest rates are high, borrowing becomes costly. A business that planned to take out a loan to open a new branch may delay that decision entirely. At the same time, customers cut back on spending because their own loan repayments go up, so businesses see lower demand and lower profits. In short, monetary policy is the central bank's way of steering the economy.